Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
Forecasting Bitcoin price direction with random forests. How important are interest rates, inflation, and market volatility? Bitcoin is a decentralized digital currency that allows users to send and receive the currency on a peer-to-peer Bitcoin network that uses blockchain technology. The Bitcoin network dispenses with the need for financial intermediaries, which can reduce transaction costs. Bitcoin was initiated in 2009 as the world's first cryptocurrency. As an asset to invest in, Bitcoin was initially the domain of retail investors. Bitcoin has grown in popularity and has now attracted the attention of institutional investors. In the investment literature, Bitcoin is sometimes compared to gold because both assets have low correlation with other financial assets like stocks and bonds, and therefore may be useful for portfolio diversification. Much has been written about the benefits of using gold to hedge assets against inflation or economic uncertainty. Recent research has identified Bitcoin as useful for hedging financial assets. The COVID-19 pandemic has brought new concerns about how to mitigate financial risk. As the pandemic grinds on and supply chain and monetary policy factors push up inflation and interest rates, questions arise as to how important business cycle variables like economic policy uncertainty, market volatility, interest rates, and inflation are for forecasting Bitcoin prices. Forecasting Bitcoin prices are important for making well-informed decisions about the market trends of this asset. While there is an existing literature on forecasting Bitcoin prices, there are several important gaps in the literature which lead to research questions. First, how important are macroeconomic variables like interest rates, inflation, and market volatility for forecasting Bitcoin prices? Interest rates, inflation, and market volatility are variables that characterize the business cycle and have important impacts on asset prices. Most asset prices move procyclical with the business cycle and increase during periods of low interest rates, stable inflation, and low stock market volatility. Assets that move countercyclical may be useful for hedging and risk diversification. If Bitcoin prices are affected by business cycle conditions, then business cycle variables should be important predictors. Alternatively, if Bitcoin prices are not affected by business cycle conditions, then business cycle variables should not be important predictors. Second, does the importance of these variables change across time? If variable importance changes across time, then models and predictions should be frequently updated, otherwise prediction accuracy will decrease. Third, are the most important macroeconomic variables for forecasting Bitcoin prices the same as those for gold prices? Existing studies predict either Bitcoin prices or gold prices, but do not consider gold and Bitcoin in the same study, which leaves unanswered the question of how Bitcoin and gold price predictions compare over a common time period. If the most important macroeconomic variables for forecasting Bitcoin prices are the same as those for gold prices, then this offers support for Bitcoin, providing similar portfolio diversification benefits as gold. In such cases, Bitcoin and gold are substitutes for one another. The objective of this paper is to provide answers for these research questions. In answering the research questions described above, the following approach is used. First, this paper predicts Bitcoin and gold price direction. The choice to predict price direction rather than prices is based on research showing that asset price direction can be forecast with considerable accuracy. Theoretical reasons for price direction predictability are rooted in behavioral finance. Behavioral finance is based on the limits to arbitrage and investor psychology. In many investing situations, true arbitrage, where profits are earned with zero risk after costs, is not possible. Investor psychology recognizes that not all investors are rational all of the time, and this can give rise to behavioral bias where market prices differ from fundamentals. Limits to arbitrage and behavioral bias lead to asset mispricing, which can be detected in price direction. The importance of estimating price direction predictability can be motivated by the importance of market timing. Investors and fund managers are interested in the sign rather than the actual value when determining asset allocation. Second, tree-based ensemble machine learning classifiers are used to predict Bitcoin and gold price direction. The decision to use tree-based ensemble machine learning methods is based on research showing that these methods have high accuracy when predicting stock price direction. For example, in predicting stock price direction for 5767 publicly listed European companies, compare ensemble methods like random forest, AdaBoost, and kernel factory against single classifiers like neural networks, logistic regression, support vector machines, SVMs, and k-nearest neighbor. They find that random forest is the top algorithm. Basic et al., 2019, use random forests to predict stock price direction for 10 companies, many of which are technology or social media oriented: AAPL, AMZN, FB, MSFT, TWTR. Feature selection is based on technical indicators. They find that the predictive accuracy of random forests is higher than that of artificial neural networks, support vector machine, and logit models. Kahn et al., 2020, used 12 machine learning methods: naive Bayes, multinomial naive Bayes, SVM, logistic regression, multi-layer perception, k-nearest neighbor, CART, linear discriminate analysis, AdaBoost, gradient boosting, random forests, extremely randomized trees, applied to social media and financial data to predict stock prices: Karachi Stock Exchange, London Stock Exchange, New York Stock Exchange, and 8 US technology companies. The random forests method is consistently ranked as one of the best methods. Third, technical indicators and macroeconomic factors are used as features in predicting Bitcoin and gold prices. Technical indicators have proven useful for predicting Bitcoin prices. A set of macroeconomic variables consisting of economic policy uncertainty, EPU, interest rates, market volatility, and inflation has not been used to predict Bitcoin price direction. Notice that a common set of macroeconomic variables is used to predict both gold price direction and Bitcoin price direction, and this facilitates a comparison to see which macroeconomic variables are important for price prediction. While existing research studies Bitcoin price forecasting or gold price forecasting, we are not aware of any study that conducts an analysis of price direction forecasting for both Bitcoin and gold using a common set of macroeconomic variables as features. A novel approach to our analysis is that variable importance is analyzed using time series cross-validation techniques, which demonstrate how variable importance changes across time. Fourth, price direction predictions are computed for a multi-step forecast horizon of 1 day to 20 days. 5 days corresponds to 1 week of trading days, 10 days corresponds to 2 weeks of trading days, and 20 days corresponds to approximately 1 month of trading days. A multi-step forecast horizon facilitates a deeper analysis of how prediction accuracy and variable importance changes across the forecast horizon. The analysis reported in this paper reveals several important findings. First, in predicting Bitcoin and gold price direction, random forests have higher predictive accuracy than logit models. This is not a new result, but does confirm the findings from many previous studies. Second, technical indicators are the most important features for predicting Bitcoin and gold price direction. Third, the importance of macroeconomic variables in predicting Bitcoin and gold price direction is mixed. The oil volatility index is an important predictor for both Bitcoin and gold. Bitcoin can be used as a substitute for gold in diversifying this type of risk. 10-year bond yields are more important for predicting Bitcoin, while inflation is important for predicting gold price direction. Gold is more influenced by inflation than gold, and this indicates that gold can be used as a hedge or diversification asset against inflation. Bitcoin has attracted a lot of attention from individual and institutional investors. Accurate Bitcoin price direction forecasts are important for determining the trend in Bitcoin prices and asset allocation. This paper uses tree-based machine learning methods like bagging and random forests to predict Bitcoin and gold price direction. The features include technical indicators and important business cycle variables like interest rates, inflation, and market volatility. Forecasts are computed for multi-step periods, and variable importance is analyzed using time series cross-validation techniques. Time series cross-validation techniques are important for demonstrating how variable importance changes across time. This paper started out by posing some important research questions. After careful analytical analysis, answers to these questions can now be provided. With respect to the first question as to which macroeconomic variables are most important for forecasting Bitcoin prices, it turns out that of the macroeconomic variables considered, market volatility, interest rates, inflation, the most important macroeconomic variables are the yield on the US 10-year bond and the oil volatility index, OVX. The inflation rate is not a strong predictor of Bitcoin price direction, which indicates that Bitcoin is not a very good hedging instrument for inflation. Notice that technical indicators like MA50, MA200, WAD, and MACD signal are important predictors for both Bitcoin and gold price direction, and the importance of these variables tends to be higher than that of the macroeconomic variables considered. Regarding the question as to whether the importance of variables changes across time, it was found that variable importance does change across time, but not enough to change the relative ranking of the variables. Technical indicators like MA50, MA200, WAD, and MACD signal are the most important predictors for both Bitcoin and gold price direction irrespective of the time period. For Bitcoin, the 10-year bond yield and OVX are the most important macroeconomic variables, while for gold inflation and OVX are the most important. With regards to the question as to whether the most important macroeconomic variables for forecasting Bitcoin prices are the same as those for gold prices, the answer is mixed. The oil price volatility index is an important predictor for both Bitcoin price direction and gold price direction, indicating that Bitcoin is a substitute for gold in diversifying this type of volatility. 10-year bond yields are also important for predicting Bitcoin price direction. The 10-year US Treasury bond is often used to gauge investor confidence and is a proxy for other financial assets like mortgage rates. The importance of the 10-year bond yield in predicting Bitcoin prices indicates that Bitcoin is being viewed by investors as an investable asset, but not necessarily as a hedge against inflation. By comparison, gold prices are more influenced by inflation than Bitcoin, indicating that gold can be used as a hedge or diversification asset against inflation. Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.